Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are. It's Friday morning, which I always look forward to, and we've had some interesting times in the markets.
Bob, we start off our show so often by answering listener questions, so we'll get underway with that. Our first listener question is, I love your show. Well, that's not much of a question, but we love to hear that. Our listener says, I think your guests are very professional and provide useful information I cannot get anywhere else. I often wished I could thank you in person. Well, thank you. Now, their question for you, Bob. Bob, as you know, trading volume on the New York Stock Exchange has been falling every quarter since 2009. This was not the case in prior bull markets. Why is this happening now, and how long can it continue until we have a liquidity crisis? How can you have a real bull market with falling volume? Is this not proof we have price discovery failure in the U.S. stock market?
Yeah, it's a puzzlement out there, volume, but volume typically grows with a bull market, but I looked back, say in 2007 and 2000, and the volume really picked up on the decline on the early breaks. So I think it's a good question to consider it, but we're in a period of inflation in financial assets, and the stock market is not like it used to be some decades ago. So you're in a wild world where the financial markets are actually dominating the economy. So this is where it happens, is like in 1929, usually the stock market leads the economy by maybe a year. That's why they include in the lead the stock market. But when you're at the end of a bubble and the stock market heads down, it takes the economy with it. So this is what we're looking for here. So I think the volume question is just one of those things that seems to go with financial markets when you're in serial bubbles, and we'll just watch and see how this one goes.
And our good friend David Mestrovic from Palm Beach Gardens, Florida, goes on to ask, the liquidity problems in the U.S. credit markets seem to be much worse. How can the U.S. government claim it has free markets with so much intervention by the central bank in the capital markets?
Oh, yeah, that there is a lot of intervention, and indeed, the central bankers have gone from buying bonds to inject liquidity, and it's the theory that if they inject arbitrary amounts of credit, then that directly drives the economy, which has never been the case. But what you've got it done is it enhances whatever the public's speculating in, which of course are financial assets. So how long they can keep it going, it's a matter of fear and greed, and you're getting very positive markets this week, and this could be on a lineup for a potential high and what we call turn of the year, or in letters, TOY, T-O-Y, turn of the year, where in the past some very good bull markets have concluded in the December-January window. One of them would be the great bubble in Tokyo with the Nikkei until the last trading day of 1989. And then, of course, there was the fabulous bull market speculation for gold and silver, which concluded, I think it was January 20th of 1980. And then an important bull market in the U.S. was the one that peaked January 11th of 1973, and that was followed by then the worst bear market since the 1930s. But also we used this in the last quarter of 2017 when we called for that big thrust that it could conclude in the December-January window. And yeah, that's when the Bitcoin phenomenon, I think its high was on December 19th. And then the overall stock market had a pretty good high in January 2018, and then there was a period of correction. So, yes, the Fed, central bankers some of them are directly buying stocks, but I think it's the same thing that they're buying high, and that's not, so I think they're going to get damaged on the next bear market.
Josh has a question. He says, I always enjoy your weekly interview. I want to ask Bob if he's familiar with the book The Creature from Jekyll Island by G. Edward Griffin, which details the formation of the Federal Reserve by a handful of private wealthy families. And if he does he believe it could be, in fact, a nefarious organization looking to capitalize on the mass impoverishment of nations, as it was similarly revealed the International Monetary Fund does in former IMF employee John Perkins in his book, Confessions of an Economic Hitman. Is the U.S. Fed a nefarious organization?
Oh, indeed it is. And Josh, that's a good question. Yeah, I've read The Creature from Jekyll Island, and as a matter of fact, the book is kept up to date on the internet. You can just Google it, and it is actually more or less up to date. I haven't looked at it for a year, but anyways. And the U.S. had two experiments in central banking before, and both ended up as disasters. So the formation of yet another central bank was nefarious. They knew that the public and many bankers wouldn't accept it, so this is where they had a secret meeting on Jekyll Island to put it together, and it was not necessarily wealthy families behind it, but bankers. And the bankers are also always looking for something to remove risk. So they dreamt up this central bank, and they called it the Federal Reserve System in order to get away from the toxic consideration of a central bank. But their theory was that, and they knew then that financial setbacks preceded recessions, and with the Federal Reserve System being the lender of last resort, that then they would prevent financial setbacks that precipitated recessions. And all I can say is that there's been 18 recessions since the Fed opened its doors for business in January 1914. So the theory doesn't work. And for a long time, certainly into the 60s, it was considered that the Federal Reserve would look after the reserve behind the currency and all would be sound. And then it was taken over by macroeconomists in order to practice their nefarious theories. And then more recently, what it's become is an agency that is out to provide unlimited funding to another experiment in unlimited government. And but they can't go forever, because I think that once this stock market rolls over, and we're getting indications that it's vulnerable because the credit markets, yield curve and spreads have taken a turn for the worse. So I think the next bear market is going to have profound implications, particularly with central bankers who have been using precious reserves to buy the stock market at high values. So they're crazy, absolutely crazy, but it has to do with power, and they won't give up power. But I think on the next contraction, the public's going to look at the trillions of dollars that central bankers have taken to prevent bad things from happening. And then when you're in a recession, they're going to say, hey, the theory doesn't work. So I think the public will become quite critical of central banking upon a contraction.
And Bob, we have a third question. The financial media seems to suggest that the party in the equity markets will continue into 2022 as multiple expansion and buybacks continue, and that the Fed's Powell will keep his foot firmly on the quantitative easing accelerator. This seems to assume that the predicted 2020 recession will only hit Main Street, in other words, the average guy, and that the Wall Street guys will continue to party on. Bob, could this actually happen?
Yeah, Wall Street partying, my God, it has been partying. But it's like anything else. The market has its own character, and speculative furies. There was a quip that we as stock analysts decades ago used to say that an analyst finds it difficult to quantify effervescence. I always liked that line. But nowadays, with the technical skills, and particularly the ones we have, you can actually measure that effervescence of a terrific speculative surge. And we've got a couple of models that have been quite reliable. And so on this one here now, we could be working on a turn-of-the-year peak to the stock market. And as we get there, we should get the readings very overbought, and we could get some of the sequential sells. So we're watching for those and will advise. But it's like the bond market, the long-dated treasuries and long Canada market, where in the summer of 2016, there was a terrific rally going on in the bond future in the U.S. and as well as Canada. Now the pitch on that one was that the U.S. yields were going to go down to zero as they were in Europe. And we looked at action in the bond future, and it was giving us all kinds of outstanding readings, and then it ended up with a terrific high and quite a hit to the market. And then last summer we had another speculative fury in bonds, and it was the same story, that U.S. interest rates, only this time, rather than going to zero, they were going to go to minus, as they are in Germany. And again, we looked at the technicals and said, this thing is really overbought at about the right time. And here's how, Jim, where seasonal helps, because often in the long bond you can get a seasonal peak in late August, and this one was August the 28th. And then you've had a substantial sell-off since and a rebound. So even on something as rigged as the long bond market was thought to be, So, and you've had central bankers buying the hell out of bonds too, but you still have had a terrific correction and setback. Now, also we're getting weakness in lower grade stuff like emerging market bonds, and that one we follow closely. So, to get back to whether the central bank can keep the party going into 2022, they couldn't keep the party going in the bond market. So I think the same thing could happen in the stock market, whereby the technicals just get so excessive again, as they were in late 2017, to provide quite a hit to the stock market. And again, probably somewhere in the next 5 or 6 weeks, this thing could conclude. And I, for one, would please to see it. So then the question also involved is how does this, or is linked to Main Street and Wall Street. So, but I'm telling you, when you're in a great financial bubble, when Wall Street gets hit, Main Street gets hit at about the same time. So, and this seems possible. That was the case at the peak in 2007, when the stock market peaked in October, and the economy peaked in December and turned down almost immediately. And that was the case in 1929 too. The stock bubble peaked in September, and according to the National Bureau of Economic Research, the economy peaked in that August. So one of the things about the stock market when you're in financial mania is that when it heads down, the economy heads with it as well. So I think the next 5 or 6 weeks are going to be very interesting.
And our third questioner also asks, it's starting to feel a lot like 1999 going into 2000, and if you recall, that was the high-tech crash. Yeah. Can history repeat here again, or are we in a new normal?
I don't know. That I think the only variations are just how extreme things can get, but fortunately we can measure them. Yeah, actually the 2000 peak with the NASDAQ was the crazy one then. It peaked in March, and I think the New York Stock Exchange Composite peaked in July. And then you had that major hit to the markets and the recession. So, yeah, I think you've got extremes, but looking back on financial history, and particularly the stock market, it always goes to extremes. Everybody gets in, and then, as the saying goes, who's going to buy after everybody's in? So it's, yeah. And the thing is to watch and use the technical tools that have guided either getting in or getting out. And I'm confident that on this latest rally, we should be able to identify the extremes.
We'll have more with Bob Hoye right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, China First Capital Bank continues its epic crash with their chair selling off shares. What does that tell us about the shape of the Chinese banking system?
Well, it's some kind of investment company, and obviously it was got overpriced, and the selling pressures involve the chairman offloading his stock. So he is getting margin calls on the way down. So it's not a pretty sight, but it does happen in the marketplace. And when insiders get over-leveraged and then they just start killing their own deal, it's sad to see, but it often happens.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap, with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Aramco, the Saudi Arabian oil giant, has its IPO up, and they say it's worth $1.7 trillion. Is it really worth that much?
Oh, huge numbers. But the oil business really does create huge numbers. And I'm not going to analyze that one. It's just that it is a huge new issue when the stock market is very overvalued. So on the longer term, I think it'll be subject to market forces, as will crude oil on the next recession. So, people are compelled to buy it, but I'm not. So that one's just going to go right on by.
And for our fast food friends, there could be a shortage of the potatoes used to make French fries. They like to make them out of large potatoes. And right now, because of poor crop conditions, early snow and rain and so on, they're only coming up with small potatoes.
Small potatoes,
yes. Which aren't so friendly for French fries. Bob, are you concerned?
Yes. A really good French fry is a wonderful experience, and I'm very dreading seeing the price of them go up or whatnot. But the headline is interesting because you had quite a failure in Canada with the canola crop. Didn't quite get harvested, and the reason is the same thing as you had a problem with concluding the potato harvest as early winter conditions arrived. And there's nothing you can do about that. So here you've had this season for many of the grains, in North America, the whole of the grain belt, where they grow corn and soybeans and wheat and all that sort of stuff. They had a late spring, cool, damp conditions, and they have to have certain dry soils in order to get that big machinery out to get planting and seeding. And then at the end of the harvest, all of a sudden it was snow and rain and cold, and that also makes for difficult harvesting. And the main thing is a shorter growing season, and that's indicative of a cooling climate trend. So we'll see how next year does, but I think the trend is cooling, and due to lower solar activity and more clouds means more cooling, and also more clouds means more precipitation. And the headline on the potatoes was early rain and snow. So, fascinating world we live in, Jim.
Bob, and besides, our waistlines could probably use fewer French fries.
I should avoid French fries with both hands. But now that we're talking about them, I'm thinking about what I might do for lunch.
Bob, thank you so much for chatting with us.
Well, good to be with you, Jim, and we look forward to next Friday.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.